Across the United States, the housing market is in a strange, almost impossible place. Sales are collapsing, mortgage demand is at historic lows, and new home construction has slowed. Yet somehow, prices, the one thing everyone expected to fall, are still stubbornly high. It's what economists are calling the housing illusion. Because on paper, this market shouldn't exist. Demand is weak, affordability is at its worst level in decades, and interest rates have doubled since the pandemic. But in reality, home prices refuse to budge. The question is, how can a market this frozen still look so expensive? Let's start with the fundamentals. The average 30-year mortgage rate in the US recently crossed 7.5%, the highest in more than 20 years. That means a typical homebuyer is paying hundreds, sometimes thousands, more per month than they would have just a few years ago. You'd think that would send prices tumbling. But instead, they've held steady, even rising in many regions. According to Zillow and the National Association of Realtors, median home prices are only a few percentage points below their all-time highs. So what's going on? The answer lies in a tug-of-war between two forces: frozen supply and sticky psychology. First, supply. The US housing market doesn't have enough homes. Not even close. Economists estimate we're short by roughly 4 to 5 million units. That shortage didn't appear overnight. It's the result of years of underbuilding after the 2008 financial crisis, combined with growing population and shifting demographics. When mortgage rates shot up, millions of homeowners who locked in ultra-low loans during the pandemic decided to stay put. Why sell a house with a 3% mortgage just to buy another with 7.5%? They didn't move. They froze. And that freeze created a paradox. Even though demand fell, supply fell even faster. With so few homes available, competition for what's left has kept prices artificially high. It's like musical chairs. Fewer players, but even fewer chairs. Now, add in the psychology. Homeowners remember 2008 vividly. The housing crash left deep scars. Foreclosures, underwater mortgages, wiped out savings. No one wants to see prices plunge again. And because most homeowners today have strong equity and stable loans, they're not being forced to sell. That means no flood of listings, no panic pricing, no crash. Instead, we get a slow, painful stalemate. Buyers can't afford homes. Sellers won't lower prices. The market just stops. It's what some economists are calling a gridlocked economy. You can see it in the numbers. Home sales are down nearly 20% year over year. Mortgage applications have fallen to their lowest levels in decades. Yet home builders, instead of cutting prices drastically, are offering incentives, rate buydowns, closing cost credits, upgrades, anything to keep sticker prices high and optics strong. Because let's be honest, housing isn't just shelter in America. It's identity, it's wealth, it's social proof. For decades, rising home values have been treated as a sign of personal success and national stability. When housing prices fall, it doesn't just hurt homeowners. It shakes consumer confidence across the board. Politicians, banks, and corporations all know it. That's why so much of the housing market today runs on perception management. Everyone, from sellers to policymakers, is trying to hold the illusion together that things are stable, that values will hold, that patience will pay off. But illusions don't last forever. Already cracks are forming beneath the surface. Affordability has collapsed to its lowest level since the 1980s. First-time buyers are being priced out entirely. Investors are pulling back, and in some cities, rent growth is slowing sharply. Incomes simply can't keep up. And while supply is still tight, construction costs are rising, making it harder for builders to expand. The question is no longer if the market will adjust, it's how. There are a few possibilities. One scenario is a slow correction, a period of stagnation where prices inch down but not dramatically. In this world, inflation cools, interest rates ease, and affordability gradually improves. It's a long, quiet reset. The other scenario is a sharp regional shakeout. In overheated areas, pandemic boomtowns like Austin, Boise, and Phoenix, prices could fall faster as investors exit and supply finally catches up. Meanwhile, stable metros with limited housing stock, like New York or San Francisco, could remain expensive simply because demand never disappears. Either way, the dream of broad affordability is still far away. And that's why many younger Americans have stopped thinking of homeownership as a realistic goal. The cultural idea that buying a house means you've made it is fading, replaced by skepticism and even resentment toward a system that feels rigged. This shift could have lasting ripple effects on how people live, work, and spend. More households are choosing long-term renting. Families are consolidating under one roof. Some are moving to smaller cities where housing is still within reach. And quietly, new business models are emerging to exploit this gridlock. Institutional investors, large funds and real estate firms, are buying single-family homes at scale, turning them into rentals. They're not waiting for prices to fall. They're betting that ownership will become a luxury and that renting, permanently, will become the norm. In other words, the dream of owning a home might be giving way to a new kind of housing economy, one where access matters more than ownership. It's unsettling, but it's also revealing, because the housing illusion isn't just about prices. It's about belief. The belief that the market will always correct itself, that housing will always build wealth, that real estate is always safe. But those beliefs were built for another era, one where interest rates were low, supply was plentiful, and mobility was easy. That era is gone. The new reality is tighter, slower, and far less forgiving. So why do prices stay high even as sales crash? Because the American housing market is running on scarcity, psychology, and inertia. It's not efficient, it's emotional. And as long as homeowners refuse to sell, builders can't keep up, and buyers refuse to give up, the illusion will hold, at least for now. But every illusion has a breaking point. And when this one shatters, it won't look like a crash. It'll look like a quiet reset, one neighborhood at a time.